In the world of finance, accurate and reliable information is not just the best practice, it is the bedrock of global trust, investor decisions, and market stability. Yet the way companies report their financial health is governed by different standards across the globe. Today we embark on a crucial journey to master the two most dominant forces shaping modern financial statement: International Financial Reporting Standard (IFRS) and US GAAP, US General Accepted Accounting Principles. They are two global pillars. Every organization from a local enterprise to a multinational corporation must speak a standardized financial language. But currently there are two primary dialects: IFRS, created and maintained by the International Accounting Standard Board. IFRS is a truly global standard. It is required reporting framework for public companies in over 144 jurisdictions worldwide, making it the common financial term for international business and cross-border investment. US GAAP, developed by the Financial Accounting Standard Board (FASB), US GAAP is a reporting mandate for all public traded companies within the United States. It is a robust, well-established framework that underpins the world's capital market. Take revenue, assets, and liabilities. Without this clarity, informed investment decisions are impossible. For professionals, whether you are an accountant, auditor, or financial analyst, mastery of both framework is no longer optional. It is a fundamental requirement for career advancements and delivering reliable financial services. Throughout this video, we will explore the fascinating history and evolution of both IFRS and US GAAP, trace their mandatory application around the world, and identify the key conceptual differences that the bosses must understand. The root of distinction between IFRS and US GAAP. To truly appreciate the differences between IFRS and US GAAP, we must first look at their foundational philosophy, which is rooted in their respective histories. IFRS is principle based. The IFRS framework is generally considered principle based. It establishes broad, overarching concepts and principles, requiring preparers to use significant professional judgment to apply them to specific unique transactions. US GAAP is rule based. Conversely, US GAAP has historically been characterized as rule based. It often provides very specific, detailed rules, guidelines, and industry specific mandates for nearly every financial statements. So, mastering financial statement preparation with IFRS and US GAAP. I have prepared a slide of almost 30 pages which gives a brief introduction of IFRS, US GAAP, their emergence, history, the differences, and how they are adapted by multinationals in the financial reporting. Let us take you through the slides. Evolution of IFRS and US GAAP standards. The histories of these standards developed in parallel. IFRS traces its roots to the 1973 formation of the IASC, which worked to create a common global framework. Meanwhile, the Financial Accounting Standard Board, or FASB, was established in the US, laying the groundwork for US GAAP. This evolution continued with the IASB, replacing the IASC in 2001, leading to continuous update for both framework to address the complexity of modern finance. Global adoption of IFRS and US GAAP. Evaluation of IFRS and US GAAP standards. Key milestone redefined global and US accounting frameworks. 1973. Establishment of International Accounting IASB predecessors. Evaluation of IFRS and US GAAP standards. Key milestones. Let us take the history. In 1973, the International Accounting Standard Board was established. Earlier, it was International Accounting Standard Committee. So IASB took over IASC in 1973. During 1970, International Accounting Standard Development, creating aiming for a common global financial reporting framework. So the basic objective was to have a uniformity in financial reporting by adopting the entire set of rules which is required for a particular financial statements, which includes each and every transactions, and the presentation should be user friendly and should be understood by each and everyone. 1973 to 1980, the US GAAP foundations emerged. Financial Accounting Standards Board was established, and the development of US GAAP as primary US standards. So there was a regular changing, the brainstorming which keeps on happening, and finally the US GAAP foundation and the Financial Accounting Standard Board was established with all the detailed structures. 2001, International Accounting Standard Board formation. International Accounting IS standards creating aiming for a common global financial reporting objective. Again, I am repeating. For the objective of the IS or the IFRS or the US GAAP was only to have uniformity, to include each and every transaction, and to make it more user friendly so that even a non-accounting person can understand the financial statement. So after 2001 till present, continuous updates keeps on happening in both IFRS and US GAAP, undergo ongoing revision to address financial complexities and enhance transparencies. Global adoption of IFRS and US GAAP. So if we check the countries in the Europe and Middle East, the European Union countries, the United Kingdom, Russia, South Africa, South Arabia, Nigeria, Kenya, Egypt, Morocco. These are the countries who need to do their financial reporting uniformly by adopting IFRS and US GAAP. Asia and Oceania countries like Australia, China, though China is converting to IFRS, India in both Indian accounting standard aligned with IFRS, Japan as well as New Zealand. Similarly, if we move towards the America and US, the countries which adopted IFRS was Canada, Brazil, United States, Mexico, Argentina, Philippines, China, and Canada. So this is the regional overview of the countries using IFRS and US GAAP standards. Corporates, when to use IFRS means who are the eligible corporates who need to use IFRS or US GAAP. IFRS is mandatory for publicly accountable entities such as listed companies and financial institutions in countries. The objective was to give each and every detail to the regulators to maintain the uniformity so that even regulators don't confuse regarding the financial statements which we are receiving from the listed organization. It is they who help the corporates in making them understand which are the formats and which are the requirements which needs to be submitted to fulfill the compliance. US GAAP applies mandatory to all companies listed on US Stock Exchange, ensuring compliance with SEC regulation. SEC is basically the regulator of the listed companies in US, Security and Exchange Commission, the way it is Stock Exchange Board of India in India. Many private US companies also follow US GAAP due to regulatory and lending requirements. The mandated use of this framework impact financial transparency, comparability, and regulatory compliance. So the investors, obviously, all the investors are not from the commerce or finance background, but still they want to understand the financial parallels in the company. They want to study the company in which they want to invest, and also they want to keep on checking the progress of the companies in which they have already invested. And it is here where the role of IFRS and US GAAP comes and takes place. Core concept framework underpinning IFRS and US GAAP. So, what is the objective behind the IFRS, US GAAP? Why these things are required? Why such frameworks? Why such policies? Why such regulations? Why such methodology are required just to give a true and fair picture of each and every financial statement, just to build the faith of the investors. IFRS conceptual framework was founded on relevance and faithful representation. IFRS prioritizes economic substance over legal form to reflect true financial reality. Shared foundations. Both framework guide financial reporting objectives. US GAAP conceptual framework, a rule-based system with detailed guidance. US GAAP focus on consistency and comparability through perspective standard to ensure uniform applications. Summary of IFRS standards. I have just listed down which are the IFRS standards which are implemented till now and how they are being used. So this is just a summary. So there are, as of now, the summary of 19 IFRS listed on this table. You can go through it. It will give you a basic idea of each and every IFRS which are being followed for the financial statement. So Indian accounting standards, many of the Indian accounting standards are aligned with the IFRS. So there is no difference between Indian accounting standards on IFRS in many of the accounting standards. So there are 19 IFRS accounting standard, international financial reporting standard, which are listed here. To take you the summary. So these are in the chronological order from 1 to 19. So key changes which has taken place, like insurance contract, IFRS 14. This has got superseded by IFRS 17. So IFRS 17, a complex standard replacing IFRS 4, providing a consistent principle-based approach to the accounting for insurance contract. So this is the changes which has taken place of IFRS 4. Similarly, in May 2024. Presentation and disclosure in financial statement, the IFRS 18, this was issued in May 2014, but however it will be effective from Jan 2027. This aims to improve the comparability and usefulness of information in the statement of finance or loss and primary financial statement. Similarly, subsidiaries without public accountable, this was issued in IFRS 19 was issued in May 2024, but will be effective from 1st of Jan 2027. Similarly, this is the summary of US GAAP. Unlike US, the chronological order of IFRS and US GAAP differs. Unlike IFRS, which is organized and there is a chronology in the order, US GAAP is organized into a single comprehensive structure called the FASB. ASB is the Accounting Standard Codification. ASC, the Accounting Standard Codification. The Financial Accounting Standard Board created the Accounting Standard Codification in 2009 as a single authoritative source of US GAAP for non-government entities. So the broad framework of these codifications are: Accounting Standard Codification 200 are generally used for the presentation part, 300 is generally used for the asset part, 400 is generally used for liability, 600 revenue. Like the Accounting Standard Codification 606, which explains you how revenue from contact with the customers are recognized in the financial statements. What are the accounting treatments? Similarly, 800 broad transactions like fair value measurement, leases, those are covered under 800. So basically there are 5 broad transactions: 200, 300, 400, 600, and the sub ASC accounting standard codifications for this US GAAP are provided. The summary is listed down. You can go through it. Carrying accounting framework: IFRS, US GAAP, Indian accounting standard, and IGAP. IFRS and Indian accounting standards. So reiterating the same statement again, IFRS is a globally accepted framework promoting uniform financial reporting. Indian accounting standard closely aligned with IFRS, but allows specific carves out for Indian context. Those standards which are not yet closely aligned with IFRS, we need to, for the multinational organization, we need to follow and implement those IFRS while making the financial reports. Both emphasizes fair value and principle-based accounting. So these are the similarities between IFRS and accounting standards, basically Indian accounting standards. Used by listed and large companies in over 140 countries, and Indian accounting standards mandatory for certain Indian companies following Ministry of Corporate Affairs mandates. So MCA is the regulation which guides you which are the organizations, which are the corporates who need to follow the Indian accounting standards, US GAAP and IGAP. US GAAP is rule-based, emphasizing detailed guidance and specific application. We have already gone through the US GAAP in our earlier slides. Similarly, IGAP, the Indian General Accepted Accounting Principles. These are the Indian traditional local standards, more oriented towards historical cost and regulated compliances. So this is the difference between US GAAP and IGAP. So overall objective of all the accounting standard board, whether it is either from the European community, either from the US community, Australian community, or the Indian community, or any other countries, the board, the key objective is to make them uniform so that it is easily understood by each and every investors or each and every end users of the financial statement. That is the key objective for all the accounting standard boards. Plus, nothing should be missed out. Each and every transaction should be recorded. So we need to study the accounting standards for each and every countries, and we need to check out which are the standards which are being applicable in those countries and is not being applicable in my country, and what is the logic behind this. If there is no proper logic, then it is better to accept those accounting standards in our financial reporting systems as well. The distinct approach, IFRS versus US GAAP. IFRS is principle-based, US GAAP is rule-based. The core difference influences how entities present financial statements, recognize revenue and expenses, and disclosure information. In going forward slides, we will take some of the key critical factors, the key line items, where we need to understand minutely how they are being incorporated in the financial statements. The four important line items of the financial statements are lease, revenue, financial instruments, and the consolidation of statements. The Indian accounting standards which deal with them are mentioned here, and the United States General Accepted Accounting Principles. The accounting standard codification is also mentioned here for your purpose. Key accounting differences: IFRS, US GAAP. Revenue recognition timing. Differ: IFRS using principle-based approach, US GAAP rule-based. Impairment testing methods vary. So, IFRS IAS 36 deal with impairment testing method. Similarly, in US GAAP, ASC 350 and 360, the two steps deal with the impairment. Inventory valuation. IFRS International Accounting Standard 2 prohibit LIFO method, while US GAAP allows LIFO method. LIFO is basically last in first out method for the inventory valuations. Lease accounting charges. Lease recognized on balance sheet compared to US GAAP. So IFRS recognizes the lease line items in the balance sheet rather than taking them to the P&L account. Revaluation of certain assets. Revaluation of certain assets. Any assets which are being shown in the balance sheet that needs to get revalued on periodical basis to show the fair valuation as on the current date, which will give a fair value or the fair true picture of the that particular assets in the financial statements, and hence the financial statements will present the true and fair view. So IFRS 16 and 38, basically International Accounting Standard 16 and 38 deal with the PPE, property, plant and equipment. Similarly, US GAAP Accounting Standard of Codification 360 and 350 not allow this. Differences in consolidation criteria and joint venture accounting. ASC Accounting Standard Codification, it is the single authoritative source of US GAAP for non-governmental entities. It was developed and is maintained by the Financial Accounting Standard Board before ASC US GAAP guideline was spread across thousands of documents. To bring those spread documents in a centralized manner, the emergence of ASC took place. So the Accounting Standard Codification helps to minimize those spreads, rules and regulations in a simplified way, and has been centralized for easily understandable by each and every end users. Key differences between IFRS and US GAAP. Again, the key line items in the financial reporting are the revenue recognition, which we need to understand how this is being treated in IFRS, and similarly how this is being treated in US GAAP. US GAAP Similarly, the financial statement presentation, how the presentation is being done by IFRS and how it is being done in GAAP treatment. Consolidation method when you are operating in multi countries or when you are operating in multiple segments, how the consolidation needs to take place and give a common financial reporting to the end users for the benefit of the investors and also for the benefit of the regulators. Similarly, the joint ventures, inventory, impairment, these are important line items in any financial presentation which we need to understand in terms when we need to understand in terms when the applicability of the rules of IFRS and US GAAP takes place for the financial reporting in your respective organizations. Financial statement presentation, IFRS and US GAAP. In IFRS allows flexible financial statement formats, enabling entities to tailor presentation according to their specific activities. You have the flexibility, you have the liberty to customize your financial presentation, but however, US GAAP prescribes standardized formats to maintain the uniformity. Differences in presentation impact how investors interpret a company's financial health and performance. Presentation flexibility under IFRS promotes clear alignment with business activity but reduces comparability. Key difference in consolidating accounting, IFRS 10 and US GAAP. Whenever you do a consolidation, whenever you have a segmented business, whenever you are operating in multi countries, apart from that, in respective individual countries' financial statement performance or the segmented performance, we also need to prepare a consolidated financial statement to check the business as a whole. So IFRS focus on control based on power to govern financial and operating policies, but US GAAP applies similar control principles but provides more detailed guidance. So in consolidation, the US GAAP financial reporting provides you much more transparency by giving the complete detailed guidance and multiple line items. Clear difference in joint venture accounting. IFRS 11. Now, let us understand the treatment of joint venture accounting under IFRS and US GAAP. IFRS mandates the use of equity method for joint ventures. US GAAP historically allowed either proportionate consolidation or the equity method. Recently, US GAAP updates increasingly align with IFRS. Basically, we need to understand what is equity method. Equity method is the accounting approach used when an investor has significant influence over another company but does not have full control. So there is ownership, there is vested interest, but that ownership or vested interest is only up to 50% or less than 50%. Means you are not having the complete control. To have a complete control, you need to be above the majority, more than 50%. So this is the difference in joint venture accounting for IFRS and US GAAP. Similarly, we also need to understand the key difference in accounting under IFRS and US GAAP. Key differences in acquisition accounting under the IFRS and US GAAP. So IFRS 3 deal with the key differences in acquisition accounting and US GAAP. AC 805 deal with the key differences in acquisition. Both IFRS and US GAAP apply the acquisition method for business combination. Recognizing and measurement of contingent consideration differ affecting timing and amount recorded. Measurement period adjustment under IFRS can extend to up to 1 year. US GAAP restrict adjustment more narrowly. Goodwill impairment testing methodology vary. IFRS uses a one-step approach while US GAAP employs a two-step approach. So this is the treatment of key differences in acquisition accounting for IFRS and US GAAP. Inventory, one of the important line item, because each and every organization, each and every corporate use the raw materials, the inventories to get the final product. So we need to be aware, we need to understand the treatment of inventory under Indian accounting standard, US GAAP, IFRS. So IS2 under IFRS deal with the inventory valuation. Similarly, ASC 330 deal with the inventory valuation. IFRS prohibit reversal of inventory write down once recorded. US GAAP allows use of different valuation techniques but applies lower of cost of market. So whenever you purchase a inventory, in terms of whatever form, the valuation of those inventories keeps on fluctuating based on timing difference. So the US GAAP gives us the real picture, and US GAAP allows us to do the valuation and make the accounting treatment and applies for lower of cost or market values. They allows us for the real picture as on date. IFRS permits FIFO and weighted average method. LIFO is last in first out is prohibited by IFRS in treatment of inventory. US GAAP permits LIFO as well, FIFO and weighted average inventory method. All the three are considered by the US GAAP except LIFO, which is prohibited by the IFRS. These choices materially impact cost of goods sold and profit levels reported. Next is the treatment of IFRS and US GAAP in long-lived asset accounting. IFRS permits revaluation of property. US GAAP generally requires use of historical cost less accumulated depreciation. So that is a traditional way of doing the accounting. Your purchase value and the depreciation which has been incurred on that balance is the value of the asset. But however, IFRS gives the true pictures because again due to timing differences, the valuation of assets keeps on changing. Either they appreciate or they depreciate. So IFRS gives a proper and practical treatment of long-lived assets accounting. Basically, these are the fixed assets. IFRS impairment requires a one-step recoverable amount test. US GAAP uses a two-step impairment approach. Initial undiscounted cash flow test, then fair value measurement if impairment indicates. Testing approach to integrate assets under IFRS and US GAAP. Intangible assets. How we need to understand what is the treatment of intangible assets in IFRS and US GAAP. So IS 38 deal with the International Accounting Standard, 38 deal with the intangible assets. Similarly, in US GAAP, ASC 350 deal with the intangible assets. So IFRS permits recognition based on identifiable intangible assets meeting criteria. US GAAP criteria are stricter, often limiting recognition to acquired intangibles. So IFRS, there are certain rules and regulations, and those criteria needs to be fulfilled before you take intangible assets valuation in the financial statement. Similarly, US GAAP criteria are much more stricter, and if you qualify, if you fulfill those criteria, then only the intangible asset recognition can be taken in the financial reporting. Revaluation. IFRS allows revaluation of intangible assets when a reliable fair value can be determined. US GAAP generally prohibit revaluation using the cost model instead. So again, the US GAAP is treating here the treatment of intangible assets are being done on a traditional approach. But however, intangible assets also gets re-verified, revalued, which IFRS permits. Impairment testing for goodwill. IFRS requires annual impairment test without qualitative assessment, ensuring timely identification of impairment. Lease accounting. IFRS section versus US GAAP ASC 842. How do we treat lease accounting in IFRS and US GAAP? IFRS section requires lease to recognize nearly all leases on the balance sheet, eliminating the operating lease. Except operating lease, each and every lease needs to be taken to the balance sheet. However, the treatment of lease in US GAAP retains a dual lease classification model, distinguishing lease as finance or operating with different impact on the balance sheet and income. So the treatment of US GAAP is a bit different on that of the IFRS GAAP. So this leads to differences in how asset liabilities and expenses are recognized and presented under each standard for lease accounting. IFRS section increases transparency by bringing most lease obligation onto the balance. So this is the treatment of lease accounting under both IFRS and US GAAP. Conceptual alignment among IFRS, US GAAP, Indian accounting standard, and Indian general accepted accounting principles. So this is the conceptual alignment among all the accounting standards which are being prepared either by IFRS, US GAAP, Indian accounting standard, or IGAP. So overall objective is to give a true and fair picture of each and every line items in the financial reporting systems. So each and every accounting standard board's objectives are aligned with common objective irrespective of the countries in which they are working. How IFRS and US GAAP differ, gap difference impact corporations. Wherever the differences arise, what is the impact of these differences in the financial reporting of the corporates? Variation in accounting standard affect the reporting earnings and profitability metrics. So obviously the earnings, the amount of EBITDA, the amount of EBIT, the earning per share, and the profits differ if there lies a differences between IFRS and US GAAP, and those statements are already incorporated in the financial reporting standards. Different treatment influences tax liability. Similarly, based on the earning, the tax liability will also get impacted. Compliance with debt covenants can vary, affecting loan agreement and credit terms. So this is an important factor. Whenever a company is borrowing from any of the financial institutions or any of the lenders, the important thing is your financial statement, how the P&L looks like. If the profit is more, if the profit is on higher side, obviously the loan agreements are a bit lenient, and even the credit terms are a bit lenient. But however, in the vice versa cases, the loan agreement becomes bit stringent, and also the credit terms becomes bit stringent. So we need to be careful while applying IFRS and US GAAP and their differences, which is impacting us on various parameters like reporting earnings, tax liabilities, loan agreements and credit terms, financial statement comparability, cross-border reporting complexities, financial statement credibility, and global comparability. Operational and organizational challenges in IFRS and US GAAP adoption. Though operational organizational challenges are there, but however, since it is mandatory from the regulator, we are left with not much choices rather than adapting it. So these are the 5-6 operational and organizational challenges. Basically, these challenges can be mitigated when you give proper training to all the staffs who are making the financial statements. Proper reconciliations are taking place between different accounting standards. Similarly, transactional historical financial data needs to be incorporated with IFRS as well as US GAAP. Mastering accounting for multinationals. Establish centralized accounting policies. Implement robust financial systems. Maintain effective governance. Manage foreign currency transactions. Harmonize the reporting cycle globally and ensure transparency reporting by standardizing disclosures. So these are the factors which we need to work on, so that minimum we can reduce the complexity to the minimum while we are preparing the financial reporting for the multinationals. Accelerating global accounting standards convergence, driving transparency and innovation through unified frameworks. So the 3 factors which are important while accelerating the global accounting standards is to bridge the unified standards umbrella of expanded reporting and light bulb of innovation. Using all this, we can accelerate the global accounting standards convergence. Maximizing value through IFRS versus US GAAP selection. Balance regulatory requirements and investors' expectations for optimal compliances. Strategic choice impact, compliance cost, accounting framework saves, financial transparencies. So these are the factors which will help you to maximize your value in the financial statements. Ensuring accurate financial reporting across standards. So to ensure accurate financial reporting across standards, we need to check out these factors, and by using them, we can most of the time we can maintain the accuracy of the financial statements while we are reporting it. So this was the PPT which was just prepared to give you a basic understanding of IFRS, US GAAP, the Indian accounting standard, the key objective of any accounting standard board, how these are being adapted in multiple countries, and which are the accounting standard which are being followed in different listed different countries, and the corporates which are listed. So thank you. This was from my side.